Hi, everyone. Thank you for joining us. We're going to get started real shortly here, just letting everybody log in. I'm Amber with Hawaii Central. Welcome to Save the House for the Kids. Today we have with us Herb Hussey from Windward Financial, and he's going to be talking about saving that house for the kids, right, Herb? And without further ado, I want to turn it over to Herb.
My name is Herb Hussey. I am a retirement planner. I've been one for 30 years. My area of work is primarily with people who are state and county employees. And I also bank at the credit union. Years ago, I was on the board of the credit union, and I have great respect for what the credit union does and what its mission is for the members. The topic that they asked me to talk a little bit about tonight is the question of how do we as individuals encourage our families to take over our homes. So let me ask you, in your folks' family and in your own history here living in Hawaii, is having your family inherit your home or buy the home, is that a value for you? Is that something that you feel is important?
Absolutely.
Okay. All right. We also know that it's hard to actually have it happen, right? Right. It's very hard because of
Yes.
because of the cost. Okay. In my practice, what I've figured out over the last several decades is we kind of created this situation for ourselves because we did one thing as a society back about 50 years ago. What we did was we monetized our home. If you go back probably to the late 60s and early 70s, you see historically a big change. The change was that people began to look at their homes as an investment. They began to talk about it as something that they could make money at. I remember growing up in Kaneohe in the 50s, where my mother and father's home cost a grand total of $12,000. And even at that point, at that time, 70 years ago, it was a very expensive thing. But by the time the 70s came along, that $12,000 home was now around $50,000. So we think about it, within a 25-year period, it had gone up an incredible amount of money relative to what it actually was. It was somebody's home. And I remember when I was working in the early 70s that if you made $5,000 a year in the early 70s, homes could be bought for $50,000. So there was a ratio there of about 10%. But if you think about it where it is now, the homes are at $1 million. Our salaries have not kept up with that. So we are now faced with a situation where the value of the home is so high, but our incomes have not kept up with that, not at all. All right. So one of the struggles I've seen with my customers is I need my home because at some point when I retire, I'm going to need money to take care of myself. I'm going to need money for my long-term care. So I'm going to sell it, and I'm going to sell it at $1 million. And so my son, whom I love, and my grandkids, whom I love, they're not going to be able to buy the home. So one of the things that I've struggled with over the last bunch of years was, what other ways are there for local families to have the homes passed to their children? What I'm going to show you is how a financial product can be used in 4 scenarios to help the kids buy the home from the parents. Okay, this is the first one. This is a situation where mom has $1 million home that has a $500,000 mortgage. The son wants to buy the home, but the son doesn't have the cash, right? What the son does is he takes out a life insurance policy for $500,000 on mom. He pays the policy. The insured is mom. When mom passes away, he takes the $500,000 death proceeds from the life insurance and he pays off the mortgage, inheriting the house free and clear. What he pays for is the premium during the years that mom is still alive. But what happens is, when mom passes away, the life insurance proceeds are tax-free. It's free money. He doesn't have to come up with money in his IRAs or anything like that. He doesn't have to borrow any more money. And all he's doing really is paying off the loan that's there. All right? What happens then? He walks into the bank and says, "Here's the $500,000. My mom passed away. I'm the beneficiary of her life insurance. Here's the $500,000. I want the house." And the house is now his. The house goes to him free and clear. It's his. Make sense?
Yes. Yeah.
Questions? Any questions?
Yeah. So and this is Chris. So in that case, if you take the life insurance, I'm just wondering how the premiums would be depending on,
Good
as
question.
you get older, you obviously have some
Yes,
medical
right,
issues,
right, correct.
so premiums could be higher. So you probably want to get it earlier.
Yes, you want to get it earlier. And I'll give you a real life example. This is a life insurance policy, a cash value policy on a 71-year-old woman who is a non-smoker. She has some health issues. She's a bit overweight. Okay, she's not in perfect health. She has prescription medications that she takes. A $500,000 life insurance policy on her is $1,000 a month. Now, it sounds expensive until you realize that what the son is doing is he's paying $1,000 a month, and he's going to end up with $1 million house.
$1,000 in what? You talking term?
No, this is a universal life insurance policy that your broker can help you go and buy. This is not a term policy. The reason I know this particular case really, really well, this is my wife's life insurance policy. So this is a policy on someone like my wife who is in her early 70s. So imagine a scenario here. The son says, "Okay, mom, how old are you? 70 years old. Health-wise, you're doing okay. Life expectancy, probably 15 to 20 years. Okay? So a $500,000 policy to pay off the mortgage, all right? He's going to pay $1,000 a month for that life insurance policy. He owns it, which means that he pays it, right? When she passes away, the death benefit of $500,000, he walks into the bank with a credit union, pays off the loan, and that house is now his. If mom still lives in the home and she's paying her mortgage over that 10 or 15 or 20-year period that she's continued to pay the mortgage, that loan is going down. So what the son can do is he can lower the amount of insurance to match the loan, bringing the premium down. Or he can keep the life insurance premium at the same level, right? And then when she passes away, maybe it's not worth, maybe the loan is not $500,000, maybe it's $200,000. So what happens is he's still going to walk into the bank, pay off the balance of the loan. In that situation, he ends up with cash that he keeps. What he's doing is he's using that product, which everybody has when they're young, but he's using it now with the intention of buying out that home. So think of it like this. Mom lives 20 years. The son is going to pay $12,000 a year for that life insurance. Okay?
Mm-hmm.
He's going to pay 10 years, $120,000. 20 years, $240,000. But at any point in that, he has $500,000 to pay off the loan. And the thing that makes it work is that $500,000 is tax-free. Any questions about this?
I have one question.
Sure, Chris.
So if let's say I currently have a life insurance,
Yeah.
could I transfer that to my son?
If you own it, yes, you can. If the
And
life,
then,
okay.
and then it becomes he becomes the owner of the policy, and he pays on that policy.
Transferring the ownership of the policy is something I would have to think about to see how it works, because it depends on the type. But usually what you can do with a life insurance policy is you can make the owner someone else. You stay as the insured.
Yes.
Okay. You stay as the insured, but you can name someone else as the owner. That person is the one that's controlling the policy, and they're deciding, yeah, I'm going to pay this because, this is an important policy. But you can give your life insurance policy to your son. And then he, in turn, if he takes over the premium, is like, okay, when I die, you're going to get this cash, go pay off the house. Let me go to the next scenario. This one. This is an interesting one. Sale for medical expenses. Mom has $1 million house, no mortgage. Okay, one heir. Mom takes out $1 million policy with an accelerated benefit rider. The policy pays for long-term care for mom. The house goes to the heir. The newer life insurance policies that are out there, you can talk to your broker, they have them. They have a provision called an accelerated benefit rider. Regular life insurance that with an accelerated benefit rider. So let's say this is $1 million policy that mom takes out. With this rider, she pays the premium, all right? But she doesn't really need the insurance because there is no loan on the house, but there is an heir. What she's trying to do is to make sure that she doesn't have to be forced to sell the house on her own because she needs the money for long-term care, right? So what she does is she has a policy with an accelerated benefit rider. If she gets sick, that $1 million life insurance policy, all or parts of it can be used to take care of her. So if she's critically ill, chronically ill, terminally ill, the provision of that policy says that $1 million death benefit, you can have all or parts of it, depending on what's going on. Okay, does this make sense? Yeah. All right. This is one where it's not about the house being inherited because there's a mortgage. It's about putting a buffer up there so that there's money for mom in case she gets sick. All right. And that one can be term insurance because maybe the mom doesn't need it for all those years. It can be any kind of life insurance that says, I have an accelerated benefit rider. So I'm going to use that up rather than selling my house. A third option. Mom has a home, 2 children, one with special needs. Mom takes out a life insurance policy. Okay, mom dies. The life insurance proceeds are paid to one child. Okay, the house is inherited by the special needs child. So in other words, it's a situation where there are 2 kids. Maybe there's a mortgage or a small one. And the mom says, you know what? I want to make sure that this one child of mine has a home. Okay. The other one, they're strong. They can take care. But I want to be fair. I don't want to give everything to one child and leave one child out. But how do I be fair? And oftentimes when you're listening to people when talking about estate planning, the question is, are you going to be equal or are you going to be fair? And one of the things that's complicated when you talk about estate planning is you don't want to actually treat different people the same way because their future and their needs are different. So in that scenario, what you have is where the house is there, you have a child that really should have the home, but what about the other child? The one that is actually stronger and can do okay. We don't want to cut him out. So what the mom does is she has a life insurance policy and it says, okay, when I pass away, the life insurance policy is going to go to you because you got your own place and you got your kids. You're going to be okay. You're going to get cash. But your brother over here, he's going to get the home because we want to make sure that he always has a place to live. Does that scenario make sense?
Yeah.
I've seen it in a lot of local families where one person has a special need. I've heard parents tell me, you know what? I'm gonna let them fight it out. The operative word that happens there is the word fight, because they're going to fight. So what I strongly suggest to parents is don't put them in a situation like that, because what happens there is that the more dominant child is going to win. The one that is not dominant is going to lose. And all you're going to do is tear the family apart. And when I've had situations where families have long-term care needs, where the parent goes into a long-term care need, oftentimes I would tell them, if who's going to take care of dad now that he has a stroke? Says, oh, my brother's going to quit his job because he doesn't like working nights. He's going to still take care of dad. I said, and what about you other two guys? Oh, we're going to stay because we get good jobs over here. But my brother, he's going to give up his job and go take care of dad. Okay, great. And I would tell them, you can pay your brother, right? And they go, oh, no, we're not going to pay him because he's going to live with dad now. He get dad's, he can take part of dad's pension and stuff. I've seen this happen where after they do that, within a few months, all the brothers are fighting because the brother that stayed home spent $3,000 on a set of tires for his truck. And you ask them, what's going on? And they're fighting. You go, why are you fighting? And he said, oh, we never told him he could take the $3,000 for the truck. I said, I told you pay him. You got to pay him as if it's a real job. You treat it like it's not a real job, this is going to happen. So in my practice, what I try to do is to settle the dispute amicably. We don't want families torn apart over this. That's my personal goal. Make sense? Okay, can I go to the last one? Yeah. Okay, for sale. Mom has $1 million house, a small mortgage, 3 children with limited cash assets. None of the kids are wealthy enough to buy out the home. So what happens is one child takes out a policy on mom equal to 2/3 of the value of the home. Not the whole thing, 2/3. When mom dies, the proceeds that are owned by the son that owns the policy, he turns around and he buys out his brother and sister. He buys them out then, and he says, how much is the house? Okay, $1 million? Okay, this is a $700,000 policy. Split them between the two of you, okay? I own the house, all right? I love you guys, aloha. So what he's doing is he's buying out his heirs, not for the full value of the home, but their portion. And the trick with that one is you have to figure out the value of the house and agree on it at the beginning. Okay, at the beginning. Because then what happens if you don't, when mom passes away and it's like, oh, no, the house is not $1 million, the house is $1.5 million. No. Okay, you have to decide that up front. So all of these things, what we're suggesting is that if we're thoughtful and creative and we plan this from the beginning, there are ways to avoid strife and struggle within our families and maybe come up with a solution.
This is Chris. On that forced sale by heirs,
yes,
you're saying you have to agree on the value in the beginning,
right?
But if you do get that policy, and say like a year down or 2 years down, the market starts moving, and now it is worth a lot more, but you guys agreed on a lesser amount. That could still cause an issue, right? So
yeah, right, and that's why conversation with heirs at the beginning is critical, because we have to say, look, okay, who wants the house? If it's no, I don't care, you can have it. Okay, but we want to be fair. But what is the limit of that? What is the limit of that? So conversation at the beginning is critical. Another issue that can arise when you have a sale by heir is if one of the heirs predeceases mom. One of the children dies before mom. What happens to their share? Does that share just get absorbed by the surviving heirs? Okay, or does their share get distributed down the line to their own children, their own heirs. So that's why that discussion at the beginning is important. My suggestion with all of these is have a conversation with your insurance professional, and then have a conversation with an estate planning attorney so you understand what this is all about. It's always better to have the conversation at the beginning of the discussion rather than try to fix it when it's coming apart. That's my point of view, Chris.
Okay, thank you.
Okay.
I have a question.
Amber has a question.
What about, like, say, I just am gonna, just give my kids the house and then I'm just gonna, become indigent and, count on, what, Medicaid?
Medicaid.
Or what is it, Medicare or what?
Okay. Amber's question is, if I have kids and I need the money, and do I go to what is the difference in Medicare and Medicaid? Let me explain the difference. All right, Medicare is medical care for the elderly. I don't know your ages out there, but I can tell you that I qualify for that. I am elderly. All right. The Medicaid, on the other hand, is long-term care for indigents who qualify for Medicare. So when someone says they're on Medicaid, it means that two things have happened. Okay, they need long-term care, and usually they're on Medicare for the medical stuff that they're going through. Oftentimes, in that scenario, if they own a home, they're going to say, you know what, I want to qualify for Medicaid, where the state will give me money for long-term care, so I have this asset. Okay, if I want to qualify for Medicaid, I may have to get rid of this asset over time. Usually, you want to pass the asset 5 or 6 years before you need Medicare or Medicaid, right? Yeah, you cannot the way the Medicaid rules work is that you cannot just give away your asset and turn around and make yourself a ward of the state, because that's just a financial burden on the state, particularly if you've had this asset. Now, the thing that really makes a difference is what is the level of financial care that you get if you're on Medicaid versus if you have your own money and then you go into long-term care. Not to pick on, not to identify things too clearly, but some of the facilities in town, like for example, Kahala or the Plaza Residences, the one up in Nuuanu where it's 24-hour care and the people live there, those facilities are running at $10,000 per month. Medicaid will pay usually $3,000 to $4,000 per month. So if you're on Medicaid, your level of care is that you're at home and someone in the family is taking care of you, or you are in a foster home. When I've had clients that come and say, I really want to qualify for Medicaid, I go, stop. Let's think about exactly what we're trying to do. You are setting out to be poor. Is that really the goal that we're going to go for? And they think, oh, the state's going to pay for me. What they're doing is they're mixing up two things. They're thinking the state's going to pay, and then they're thinking of something like Arcadia or Kahala Nui. No, the state will not pay for you to go to those facilities. The state is going to pay you enough money that you will be in a care home out on the west side. Someone's house. You will live in someone's house. In someone's house. So it's a learning experience when people when they think about that. They think you're going to go to Kahala Nui, and I think, no, you're not. Also, if you're in Medicaid, Medicaid is distributed county-wide, and you can only be used in that county. So, for example, if you live on the island of Kauai, and you're living on the Kauai County, when they pay Medicaid to you, you're going to go to a home in Lauai. You're not coming to Honolulu and going to Kahala Nui. No, we wouldn't be there. Okay, so that's a difference. I've rambled on. It's 1:45.
Well, before we go, I just want to thank you all for coming, and not sure what was going on with the other laptop. But I do want to say that we will be putting together a video of today's presentation, and that will be made a resource on our website, as well as we will be broadcasting the project on Olelo, so that we can open it to not just to more members that maybe weren't able to come tonight, but also to the community that we serve, Oahu at large, people that live, work, worship, and go to school here on Oahu, as well as their family, their immediate family. So thank you again, everyone who came, and thank you again for your patience. We have a bunch of other workshops planned. It has been 2 years since we've been able to do these workshops, and we're just glad to be back and able to offer this as a benefit to our members. And we invite you to come in next time, maybe come in and see us in person. And with that, I want to say thank you for coming, and ahui ho.
Thank you.